March 2020. It was at this time that the US Federal Reserve announced for the first time it was buying US corporate bonds in the primary and secondary market. Now, LQD is an ETF that looks at a basket of investment grade bonds and is particularly fascinating to see how LQD traded before, during, and after the announcement. Why? Because throughout, the Elliott wave pattern was consistent.
So let's take a closer look. Here's the headline from CNBC on March 23. The Federal Reserve pledged to buy assets. And as you can see in the comments here, they pledged to buy corporate bonds, investment grade, for the first time. And when you look at the chart, March 23, 2020, this is where it came. The day after the bottom, the Fed announces it will buy corporate debt for the first time. But what is striking is what happened before the announcement. Now, when we go and we look from the peak, you can see from an Elliott wave perspective, this entire decline, mini crash, was a three-wave affair. As you can see, the knot is in the middle, as they say. So you had the first leg down for A, some type of probably triangle for B, to the downside in C. Now, in real time, the question becomes, how do you know this was 3 and this 3 wasn't going to continue to be a 5? Well, one of the takeaways you can use is momentum. And as you can see in this three-wave decline, as the market was falling, momentum was not increasing to the downside. In fact, at this low, there was less momentum. That is not what you typically see in a third wave. It is more what you see in an ABC. So before the Fed announcement, it was a three-wave decline, means the setup was there. The bonds would continue to rally regardless. And when we look here, you can see the rally since took on the form of what looked like an impulsive move higher. Now, in real time, you had an option. The option is, do you count this as 1, 2, 3 to the top side, and this is the beginning of 4, which means you're looking for a new high and then a top? Or do you give the market a bit of room to breathe? 1, 2, 1, 2. Well, in a trading perspective, in real time, you should allow for both. Both counts are bullish, but remember, when you have such an aggressive move to the downside, you tend to clean out positions such that momentum suggests there was no further positions. You had a clean slate, so you can allow for 1, 2, 3, but you also want to allow for 1, 2, 1, 2, especially because this third wave was rather small. And in the subsequent decline, 1, 2, 3, 4, 4 did not overlap 1. So still, this count was valid, but you can see 3 was significantly shorter than 1, which means the fifth wave had to be smaller than this third wave because 3 can never be the shortest. Remember how positions were cleaned out here. Is it likely that this was going to be all there was to the market, or could have been this 1, 2, 1, 2? This is what we preferred. Again, in real time, you run them both in your mind. They're both bullish, but this is a bit of a warning sign. Clean positions here, not much to the upside in the third wave. And as you can see, the final result from this was indeed a significant move higher, which means this cannot be 1, 2, 3, 4, 5, because 3 would be the shortest wave. You had the divergence here, which is typical of a third wave. So what this implies is in real time, when you have such a clean out to the downside and positions are no longer there and they're flat, allow for 1, 2, 3, 4, and maybe this you would have thought 5, but at the same time run with 1, 2, 1, 2. Always give a market room to breathe. Let it tip its hand.
So there you have it. LQD is not only an example of how to count the waves in real time, but it stresses the importance of market psychology, especially in an environment of heightened volatility. Now, given that volatility is unlikely to decrease into the end of the year, it seems that counting the waves is not only an important part of any trader's toolbox, but going forward, maybe even a necessary one.